What's happening, Internet? My name is Andrew, otherwise known as Drewicious. I'm here for another segment in the Trading Foundation videos, my hopefully lovably lo-fi video series for new traders. I'm doing my very best to communicate some stuff that I wish I would have known when I first started trading, and we'll try and do it in as entertaining and concise a manner as possible. That's a total lie. I'm going to ramble on. I have no script, but I do have a rough outline, so let's see how that goes. All right, guys, so as mentioned, this is Drew's basement. We are literally in my basement. This is where I record most of my videos. Maybe not all of them, but most of them so far. I am unkempt. I should probably have showered, but it's the internet. You'll get over it. Can't tell what's going on over here. I've got a glass of delectable red wine that came from a box. So I feel like we're all set to jump in. So guys, we have part 3 coming up today. We're going to talk about managing risk in trading. And we got a couple things that we're going to cover in that space. We're going to talk about betting and trading, risk and reward, sizing, and scaling. So a couple of topics. And again, we'll try to get you out of here as quick as possible. I know you have better things to do than look at videos on the internet all day long, right? Yes. All right. But before we get started, I am trying to be slightly more organized, and I'm putting time into slide decks for you guys, visual pizzazz. That means I need to ask you for a favor. Do me a huge favor. Click that like button. Subscribe to the channel for all I care. It does help me out. Not in any way monetarily, but it's nice for me to know if I'm going to put time into these videos that it is helping people out. And if I don't see the likes and it's not helping people out, then I probably got other stuff I could be doing. So help me out and let me know that this is useful for you. And we're going to try a new segment, I guess, today, a thing I've been meaning to do and just have been too lazy. But we're going to start the basement journal. And generally speaking, this will be, I don't know, bonus footage, an extra video I took during the week, something, an adventure perhaps I go on. My basement has many wonders in it, which you guys will come to learn over the course of time if you click like and I keep doing the videos. But today, I just figured I'd share a little bit. Some of you that know me from the Discords know I haven't been trading that much lately, and you don't need to know my whole backstory, but one of the big reasons for that is because several weeks ago, my partner and I went and rescued a dog. He's a really good, sweet dog, and but he is just completely untamed, or was completely untamed. He's making great progress. But I wanted to show you guys kind of what we've been dealing with here. Stash of Selleck, one of the other traders that I talk with on a very regular basis, is extremely familiar with what we've been up against, but the rest of you have no idea. So I thought maybe I'd share this video. The dog here on the left is that's Grizz. He's the rescue, and the dog on the right is Ginger. She is our existing dog. She's the sweetest thing on the planet. Extremely good dog. And Grizz is part Malamute, so he talks a lot. For anybody that knows anything about Malamutes, they're extremely vocal breed, and this is Grizz and Ginger getting to know each other here in the first couple of weeks. Yeah, that's pretty much been our life for like a month. So at any rate, that's what the basement journal brings you today. I will try to have, I can't say that was interesting, but I guarantee you it was new. You've never seen that before. Admit it. If you've seen it before, I need to talk to you about my privacy. All right. So guys, let's jump into the content for today. So as I said, we're going to talk about managing risk, and we're going to start with talking about the difference between betting and trading, or gambling and trading. Now, honestly, this is a conversation I had with my partner when I first got around to trading, and she's like, isn't this just basically gambling? And I'm like, no, it's totally different. There's professionals. They wear suits. Don't worry about it. But the truth is there's a lot more to it. And I do want to underscore some of the differences between betting and trading. And the truth is there's not a lot of difference from what's out there and available to people. The decision about whether you are betting or trading is 100% up to you in the way that you approach what you're doing with your money. So down here, I've got a little bit of a table that helps kind of articulate the difference. At least it helped me think about the difference between gambling and trading. So bets or gambling frequently built on hope, right? We hope a thing is going to happen. We don't know for sure, right? There's no necessarily science behind it. Now, clearly in some gambling circles, you can spend a lot of time. You can science the shit out of some gambles, right? You can get down, you can get all the statistics, especially if you're talking about sports, about likelihoods and matchups and all that kind of stuff, which I greatly respect. The people that geek on that and are really good at it, I have a respect for people that can consistently develop consistent results there. But in trading, we start with the thesis, right? And we want to make sure that we're not going into trades with just, I hope it goes up or I hope it goes down, right? If you hear the word hope coming out of your mouth or rattling around in your brain, and I still say it sometimes too, like, look, but just be aware that that's not a great sign. Hope is not a thing that we want to base our trades on. We want to have a thesis. We want to understand why we're putting our money at risk. We want to make more money, right? That is the whole goal here. So trades start with the thesis, and that thesis, we'll talk about that a little bit more on the next slide, but that thesis should guide you through your trade. Bets are typically fueled by emotion, at least in trading, right? We're hoping that thing happens, and we are looking to have an emotional reward. We want to feel good about it, and if it doesn't work out the way that it goes, we're going to feel bad about it, but we're being led around by our emotions. And this is really, I'll be honest with you guys, that's one of my biggest hooks. I still make a lot of emotional trades. I look at a thing, I think I see something happening. I don't pause to ask why I'm taking the trade. And as a result, I find myself sometimes in trades that aren't real well thought out. Contrast that with trading. We've got a plan, right? We know what we're looking for. And if we don't see it, if our thesis isn't validated, we're going to stop out, right? We have an amount of money, and this is a key mindset. We're going to talk about this more in the next video when we talk about inner and outer game. But you essentially are taking some of your money in order to find out if you can make more money. But as soon as you take that money out and you put it down on the table, just consider it not yours anymore, right? That money is gone. That is your risk. And your intent is to gain a reward from it, but it is entirely possible. And in fact, guaranteed that at times you are going to lose what you put on the table. So, but bear in mind that there is a plan that helps you figure out how much you're willing to lose and how much you're looking to gain as a result. We're going to talk about that more in this video as well. At the end of the day, if you're gambling, you're going to end up with a feeling, right? You might end up with some money. You might end up with a loss. But the largest thing there, at least for me, when I think about it, is about that feeling that comes out of the result of it, right? And it's not the data. And in some ways, the best traders are very dispassionate about their trades, right? Of course, it's amazing to get a great trade or for something to work out the way that you thought or to feel good and proud about the work that you put into something. But if you've got a good system, your trades are generating data that helps you improve your system to make better trades in the future. And we're going to talk about that a little bit more here as we go as well. So I wanted to talk a little bit more about the thesis, the plan, and the data, right? Those outcomes that we see from a trade as opposed to a gamble. So I've got a chart up here. It's just of Intel. I didn't pick it for any given reason other than it was handy and I didn't have a lot of stuff drawn on it. So, but this is a daily chart. I got a couple of simple indicators on it. There's not a lot going on. But when a trader who has a plan takes a look at a chart like this, and if they think they see something, they will develop a thesis like, oh, I think I see a pattern or something here that leads me to believe that I may have a statistical edge on what happens next, right? No one, and let me be super clear about this, even though on the internet, trading discords, everywhere you go, there are going to be people out there that try to tell the future. They're going to try and be fortune tellers, and none of them are, right? Like it is rampant in the field to say, here's what's going to happen next. And the truth is, no one knows for sure. They may have developed good statistical odds. They may understand patterns very well, but telling the future is just not possible because there are too many factors at play in any given day or any given minute in the market to truly know what will happen next. And things can change because of news, because of a catalyst, because of things going on nearby, because of something that happened to another ticker that's related in the same sector. We don't know for sure. No one knows for sure. All we can really do is develop these statistical models that help us win more often than we lose. And that is the edge that we're looking for. Back to, I'll get off the soapbox. What a thesis is a statement about here's what I think is going to happen next, or here is what I anticipate, right? We believe that we see something here that leads us to believe that we have some idea what might happen next, right? We don't know for sure, but we have an idea. So that thesis, if I were to take a look at this, I might see this kind of broad dip here with maybe what looks like a potential inverse head and shoulders. And that's, if you're not learning chart patterns yet or technical analysis yet, don't worry about it, right? But I might see some things on this chart that lead me to believe that this ticker might be getting ready for a reject or a bounce down, right? And I'll just kind of talk through it as I look at this. I see this outside candle here is getting kind of close to a level up here where the ticker rejected before, right? There's a little bit of a supply level here, and we might be coming up into it. And I might be anticipating that this ticker will bounce and come back down again. So my thesis might be, I believe that this ticker will reject at the previous high right in this area here. Next thing I need to do is develop a plan for that. Well, I'm going to wait until that price gets a little closer to that level. Then I will take a short position. Now that can be taking puts if you're playing options, or just, taking a short position if you're playing the equity itself. And I have an idea of what I'm looking for. I will, if it drops $2, right? If it goes from 32 to 30, I will take profit. And if it goes from 32 to 33, I will stop out and I will move on with my life. That is my thesis. That is my risk statement and my profit target, all summarized into a concise plan. And at the end of the day, either it will work, right? It will go up, it will catch, and I'll make my $2, or I'll lose my $1. And I will document the finding from that, potentially in a journal. And I'll look at it to see if there is something I could have looked different. I can take a look at, hey, maybe there was something to do with the moving averages, or maybe there's something to do with the way that the ticker was moving. But at the end of the day, if I can find something to learn out of failed trades, and we're going to talk about that a little bit later on in the video, I am always improving my system. All right, so that leads us next to risk and reward. This is a phrase that gets used a lot. It is extremely necessary and valuable phrase, so we're going to talk about the concept a little bit. Now, within risk and reward, we talked about this a little bit on the last slide as we talked about like my trading plan, right? So I was looking at Intel. Hey, if it gets to 32, I'm going to take a short position, and I'm looking for it to go to 30, right? The reason that that's there, or the reason that I developed that plan, is because of structural awareness. I'm looking at that ticker and I'm seeing things in there that make me believe that the market may react in a certain way, right? So structural awareness, if we're making decisions in a vacuum, if we're just looking at one candle or a couple of candles without some awareness of if this level is important, if there are trend lines nearby, if there are other things going on or big catalysts coming up in the news, anticipated ERs, right? Big things like PPI, FOMC, things like that. If we don't have some awareness of what's going on around us, we're going to get run over on a regular basis. So structural awareness is really important as we think about managing our risk, and especially as we seek to capture our reward. Now, one of the things that a lot of traders, and this took a while for me to get used to, and I talked about this, I alluded to it a little bit earlier, but truly accepting your risk. That is something that a lot of traders struggle with, especially if they put on a trade and they see it go red right away. It is hard not to have an emotional reaction, right? Because you see the trade not working, right? You feel like you've made a mistake. It could go against you. What have you done wrong, right? There's a whole labyrinth of psychological responses that come up when a trader sees a trade not necessarily go exactly the direction, right? You'd never put a trade on and expect it to go red right away. That's not what you're looking for, but it's going to happen. So, but when you truly accept your risk, you know that when you put your money down, right, when you take your stop loss, right, in my previous example, the $1 I was willing to gamble to see if I could make $2. When I put that money on the table and I know that I could lose $1, I accept that that dollar is not mine anymore. I no longer expect that dollar to come back to me, right? I have a plan for it to come back to me with friends, but I have to truly accept that that money may never come back. And I can be very comfortable at that point with a trade that goes red, because if it doesn't go all the way to my stop loss, my plan is still in effect, right? As long as you're following your plan, it is okay for a trade to go red, because your thesis should hopefully lead you to your profit. And if it doesn't, so be it. You lost $1, whatever, move on, right? But you have to accept that risk before you can truly be comfortable with the trades that you put on. Now, conversely, knowing your target is super important. And guys, I'm going to tell you all my bad habits on here. Okay. I sometimes take a trade just looking at it saying, oh, this is definitely going down. And sometimes I do that too quickly, as I mentioned earlier, and I emotionally take a trade without necessarily knowing where I'm trying to get to. I'm just like, I don't know, it's going down. We're going to see where it goes. Sometimes that works. A lot of times it doesn't, right? The trades that I do better in, without a doubt, are the ones where I've looked at the structures, I have a sense of where things are going, and I know where I'm trying to get to because I see a bounce, I see other structures, I see supply or demand or support or resistance. But I know where I'm trying to get to, and that helps me maintain composure when the ticker is kind of moving around, right? Like I said, if it goes red for a little bit, I know where I'm trying to get to, right? I'm not uncomfortable that it's just red and I don't know what happens next, right? That loss of awareness of what's going on around you and the lack of a plan will cause you to panic and make emotional decisions. And this next one, I cannot stress enough. Use stop losses, guys. There are people who don't play with them. There are people who don't play with stop losses for a reason. And if you can articulate why you don't use a stop loss, good on you. And sometimes I don't either. Until you get to the point where you can say, here's exactly why I don't use a stop loss. Use a stop loss. It is an automatic way. If you're not familiar, it's an automatic way to say if a ticker or a contract loses this much, right? If it drops 20%, take me out of the trade. If it drops 30%, take me out of the trade. It does wonders to be able to turn your eye on a trade and just know, like, look, either it's going to work or it's not. But I know that stop loss will keep me from losing all of my money, right? It will not go all the way against me. It's not going to moon, and when I'm short, it's not going to tank when I'm long. The stop loss makes sure that you can be comfortable that the risk that you've accepted already is the maximum amount of money that you'll lose. And you don't have to be looking at it. Otherwise, especially if you're playing options, and I hope if you're doing this foundational video series that you're not playing options yet, get good with equities before you touch options, because they are far higher risk and reward. And we will be doing a session. I'll be doing a series on those after I finish up this foundational series. But make sure that you use stop losses all the time, guys. It will help you stop from blowing your account up. At least give you a little bit more time. All right. And finally, the risk to reward ratio. That essentially is the relationship between how much money you're willing to lose and how much money you're looking to make when you put on your trade. If you go back to that Intel example that we talked about a little bit earlier, I was willing to risk $1 in order to find out if I could make $2. That is a 1 to 2 risk reward ratio, right? I'm willing to risk $1 in order to make $2. And we're going to talk about why that ratio is a little bit is extremely important. And you don't have to do 1 to 2. It's a good starting point, but you can do. I know people that trade with 1 to 1. I know people that trade less than 1 to 1. People that look for more than that. I'm going to show you why that ratio is so important and how profound that can be on the result of your portfolio. Now, I am going to be very clear here. I didn't make this table. I found it on the internet, and to whoever made it, thank you very much. I'm not trying to steal your thunder. I just needed a quick example. Didn't want to make it up. I promise you I know how to use Excel. But what this is a table articulating the risk to reward ratio that I was just talking about. And you can see here that depending on what you're willing to risk and what your reward is, has a profound impact on your break-even rate. And so let's kind of start here at the middle, right? If you always risk $1 in order to make $1, you have to win 50% of your trades in order to just break even. So if you use 1-to-1 risk to reward, right? I'm willing to lose $1 in order to make $1. You got to make 50% of your trades or better, right? So at 51% win, you are profitable. Anything north of that, you're doing great. Let's look at a 1 to 2% risk to reward ratio. I'm sorry, 1 to 2 risk to reward ratio, like the one that I called out in the Intel example. A 1 to 2 risk to reward ratio means that I need to win only a third of my trades, right? I can afford to lose 66% of my trades and still be profitable. And I'm going to say that one more time. With a 1 to 2 risk reward ratio, I can afford to lose 2 times as many trades as I win and still make money. That is a really important concept. If you stick to a 1 to 2 risk to reward ratio, you can lose most of your trades and still make money. And if you can see what happens here, if you get 1 to 3, you only got to win a quarter of them. 1 to 5, don't even have to hit 20%. You can afford to lose you can afford to lose 4 out of 5 trades and still make money, right? Conversely, if you are going the other direction, it really increases the number of trades you have to win, right? Your accuracy has to be really good. So that risk to reward ratio is a really good way to make sure that you know that you're on the right track to being profitable by the end of the day, by the end of the month. So look at this chart, burn it into mind, go look it up on the internet, come back and look at the video, make your own Excel spreadsheet, right? It's not hard to figure this out. If you know that your risk to reward ratios are sound, you know what your break-even rate is without even having a look. And look, guys, losing is going to happen. It has to happen because the stock market it's not predictable, right? Like I said earlier, you're gonna take losses. The hope is to keep those losses at a rate and at a loss rate and at a risk rate that allows you to continue to be profitable. It is critical that you at least stay at break even. And you'll hear people say this, that the most important thing in trading is just being able to continue doing it, right? If you blow up your account and you don't have any more money, then you're done trading and your journey's over, right? So the most important thing you can do from a self-preservation standpoint is make sure that you have capital available to keep on going. So even if you get down, just manage your risk to reward and get yourself back up. All right, guys. The other thing I want to touch on in here is just as we look at this risk to reward, right, and the break-even win rate and the number of losses that you can afford to take, there can be for some traders a real psychological impact from taking a loss. And to the best of my ability, I want to try and unpack that impact. Expect the loss. And I've been kind of saying it throughout the video, but I really want you to embrace that. Expect losses. Losses are okay, especially if you figure out what you can improve upon next time. And we're going to talk about that a little bit later as well. All right, guys, we're going to move on to the next topic here, sizing and scaling. You'll hear the phrase sometimes, focus on base hits, not home runs. And what I mean by that, and I feel this at a very deep level, because I very much, when I first started focusing, was trying to hit home runs. I was in a big hurry. I saw people making these massive gains. I saw people posting these flex shots, and I very much wanted to 10x my account today, because it really would have been great if I just could, get a couple of them 500% gainers on my account, and then I will be driving a Lambo. Are you going to get those occasionally? Sure. But I think the reason I like this particular analogy is that it really does sort of reinforce that, look, if you're always going up there and always swinging for the fences, sure, you might connect every now and then, but you're going to get a lot of strikeouts, right? You're going to get a lot of losses, and really good home run hitters, they get 300, right? Like a crusher at the plate might be batting 300, 350, right? Which is really outstanding. That means that they are missing the majority of the pitches coming their way, right? So the base hits are what keep you going, right? And you'll hear this one too. It is easier to get 10% trades than 100% trade. And that's super true, right? 10% trades are relatively available. 100% trades are hard to come by. So if you just are always shooting for the fence, if you're always dropping a maximum amount of your money in order to get all of it back in a big, huge trade, you're going to lose a lot of your money. shooting for that big, huge trade. And the more and more that your P&L dwindles, the harder it is to climb back out of that hole. So focus on small gains, consistent gains. And when you're starting out, presumably you're not starting with a $100,000 bag, right? Hopefully you've grabbed a small amount of money that you are comfortable losing in order to learn with, or even better, you're not even using your money. You're starting with paper trading or using my favorite feature in Thinkorswim, the on-demand feature that lets you trade like it's real time without any risk to your checkbook. But when you do start using your account money, don't use a lot of it. There are ratios and formulas out there about how much you use from your portfolio. And I would advise that you try to stick to 1 to 5% of your portfolio as a max risk in any given trade, right? Because if you're willing to risk 1% of your portfolio, let's just say that you have $100. If you're willing to risk $1 for each trade, then you can be wrong 99 times and still be in the game, right? If you're using 10% of your portfolio, a third of your portfolio, if you're going full YOLO and just dumping the whole thing on one bet, you live and die by the YOLO, right? You can be wrong one time if you go in 100%, and then you're done. Count's blown up. You got to start over. You got to go find more money. So it is, look, and I'm not going to lie, I totally did that. So I know what I speak of. So try to help yourself out. Give yourself some time. Don't imagine that you're going to be driving a Corvette tomorrow, right? Imagine that it's going to take you a couple years to get comfortable with, to become a good trader. And if you're in a bigger hurry than that, or you got to get something done, or you're trying to make rent this week, trading should not be what you're doing with that money. You should be doing something else with it. This is if you apply pressure and time, you're going to make mistakes and you are going to be very, very sad. And I have some really scary stories from people who have done that and found themselves in a very dark place. Please don't do that to yourself. Last thing I'll talk about, and very briefly, I don't want to go into it in depth, but as you get more comfortable in using, as you gain some consistent results, you can use scaling in and scaling out as a way to give yourself a toehold in plays that you're interested in. And essentially what that means is that you don't go with a full lot size or a full trade size in order to get started. If you go back to that Intel example that we were looking at previously, if you think it's going to go up and bounce a little bit, but you don't want to wait until it gets there in case it turns around early, you can start with a small commitment early on, right? And let that go red a little bit because you're planning on adding some more in. But you can scale in small amounts, and as you get validation that the trade is working out the way that you want, you can get in heavier and heavier. Conversely, as the trade plays out towards your price targets as hoped, you can start to scale out. And what's fun with that is, look, if, on that Intel thing, if let's just say that I took 10 shares and, maybe right where the ticker was at, I bought 1 share just so I could keep an eye on it. Right. And as it got closer to my price target or my entry point at 32, well, then I could add in my other 9 shares, right? Or I could kind of add them in as I got closer to it. And then if it goes up to 33, all right, I'm out. I take all my 10 shares out. I was wrong. I'm going to go find another trade. If it does start going my direction and it gets to 32, it goes down to 30, right? My price target, and I've made my $2 per, not contract, sorry, per share, then I could take, 9 of them off of the table, collect all that profit, and leave 1 to see if it tanks further, right? Maybe I get a flex shot out of that. So you can leave runners without risking the majority of your portfolio and still make some extra cash that you weren't actually planning on making. And if that thing goes the other way and you lose that money, whatever, you've already put money in your pocket. Can't hurt you. And if it goes way far in your direction, you might have a very impressive profit shot to tell all your buddies about. So I do want to talk a little bit about compounding gains. I did put this chart I made for you guys, just for you right before this video, just to prove that I know how spreadsheets work. So here is a compounding formula. If for example you started with $1,000 and every day you manage to have a 2% day. That's not a huge day. It's realistic for many traders. If you're day trading, right? If you're swing trading or position trading, right? You might not be looking for that, but this is just an illustration, right? At a relatively modest 2% per day, with your $1,000 account, by day 5 you have made $82. It's not a ton of money, but it's not bad. You know, it's $82 you didn't have at the beginning of the week. By day 10, you're getting close to $1,200. Right? If we get up to day 50, which is, that's 10 weeks of trading, right? But again, if you're consistent, you're getting those base hits at 2% per day, you've more than doubled your money, right? In fact, you've made $1,638 on your original $1,000. That's not bad. And by day 100, right, 20 weeks of trading, that's $7,000. That's a 700% increase, all by just getting 2% gain per day. Now, are you going to get 2% every day? No, you're going to probably get, maybe you get 5% some days and you lose 1% the next day, and then you have a big boom day and you hit 20, and then you make some bad decisions and you lose 15%, right? It's going to be all over the place, right? But this is where those base hits really come into play. If you're not stretching, if you're not risking too much, if you're not putting too much on the table for low conviction trades, you can minimize those big red days and collect as many possible small days, right? And this isn't the live chart. I've got the live chart. We could go look at it, right? But we can pull that gain down to 1%. And yeah, obviously the numbers, get smaller, but you still make a lot of money by day 100. So our goal here is consistent, small profits, and occasionally you'll get lucky and get a home run. But don't shoot for it. Just shoot for the 2%, the 1%, right? Get a little bit. Just shoot for $10 a day. Anything starts, right? All gains compound if you get them. So get something, get it green. Don't let it get away from you. All right, guys, that is the end of part 3 for risk management. If you have any thoughts, if you think I missed anything, I am always looking to learn more. And I know many, many traders know many, many more things than me. I am by no means an expert or a guru. I'm just willing to share what I've learned, and I've invested a fair amount of time in it so far. So hope this has been helpful. I hope to see you guys back on the next video. And if you have anything else for me, leave a comment or a like down below. And I hope you guys have a good rest of your, day, night, whatever it is. Enjoy it. Talk soon. Bye.